Fund Supermart, your online gateway to unit trusts.
Bond investments offers diversification benefits to a portfolio of mixed assets. The consistent stream of coupons from bonds may provide liquidity to the portfolio and can also be used for reinvestments. When included in a portfolio of multi-class assets, bonds may help to moderate the portfolio overall volatility during market uncertainties. Bonds tend to hold their value during major market corrections like we saw during the global financial crisis in 2008 and the European debt crisis in 2011. The strategy aims to provide a stable and consistent return above cash alternatives such as deposits or money market funds. Predictability and visibility of stable returns is the hallmark of the strategy. As such, the strategy focuses on investment-grade credits with leading market share of systemic importance in defensive sectors and which are professionally managed. The strategy buys into bonds with an investment horizon of up to 3 years. 3 years is a good compromise between risk and return. It is relatively easier to form an expectation of the performance of a bond issuer 3 years into the future compared to a 5 or 10 year down the road. The 3-year duration is also relatively short, and the strategy may therefore be less affected by changes in interest rates or credit spreads due to market volatility. The strategy buys into global credits across local and hard currencies. With an investment universe so wide, that may enable the strategy to seek out the best risk-adjusted returns across countries, industries, and sectors. The strategy is flexible in allocating investment across Asia and the emerging or developed markets wherever value prevails or risk can be minimized. Foreign currency exposures are hedged back to Singapore dollar. As such, the strategy is not subjected to the uncertainties of currency fluctuations. To make successful investment, one needs to have intimate knowledge of the companies invested. Together with about 20 analysts, we conduct in-depth analysis such as macroeconomic numbers, industry drivers, business outlook, strength of ownership, management expertise, and debt structure. These findings are summarized into a proprietary credit scorecard to facilitate relative valuations among credits. Investment recommendations made from the pool of analysts are carefully deliberated, and we consider the suitability, the risk and return profile, as well as diversification benefits. This is to ensure optimal risk-adjusted return enhancement for the entire portfolio. The strategy is naturally positioned to take advantage of the rising interest rate environment, employing a laddering investment process. Every year, the available cash from the subscriptions and matured bonds are invested into bonds that are either matured, putable, or called in 3 years' time. A typical bond maturity profile of the portfolio will be spread across the 1 year, 2 year, and 3 year time horizon. In the event of rising interest rate, available cash in the current year will be reinvested at a higher interest rate. As such, the strategy is positioned to ride the momentum of rising interest rates to enhance total return for investors.